So I'll talk about setting your angel investor profile, selecting the right investment strategies. I'll tell you that I don't invest that actively in startups myself and the reasons why. And I can guarantee that after my presentation, you won't learn a lot about investing in startups, but hopefully you will get some new ideas about alternative investment, directions that you can use so you can make money in your own lifetime as opposed to investing in startups and never making money. So I want to talk through my experience, the way I've built businesses, and therefore how I think about investing and why. Because I think this understanding why and asking yourself the question of why you want to invest in a startup or be an angel investor is a good point to start in order to be successful. In terms of my experience, so I've started my first company in 2012. It was called Green Finance. Now it's rebranded to Avafin. Consumer lending, mostly online. So we did these quick short-term loans. Then we kind of moved into different types of loans, asset-backed company loans, etc. But most of my business has been in lending. Since 2012, I sold the first business for over 50 million, and we sold the company not in kind of one go. We sold it over effectively like a number of years, starting with 2019 all the way to last year when we fully exited. That's myself and my co-founder. Unfortunately, we didn't make the whole 50 million ourselves. That would be nice, but we had these annoying things called other shareholders, so we had to deal with them. They got paid as well. So the company is this year doing about 150 million in revenue, over 500 employees, operating in a number of countries. So that was the first business I started. I got lucky that was successful, and so I stayed in that industry. Now looking back, I've started businesses across around 15 countries, and the businesses that I've started, they at the moment employ certainly over 1,000 people. And since 2020, which is when I started selling off my shares in Green Finance and stepped down from a CEO position. I was CEO there from day one since 2012. I have been focusing on effectively what I call company building. I don't like this term serial entrepreneur because it's hard to pronounce, so company building is just easier. Still with my co-founder, the same guy that we started the first business with. And so what we do is we look for ideas in terms of a product, in terms of a country, still within the fintech and lending space, maybe broader, not only lending, but generally in the fintech space. We look for new countries that we want to do business in. Once we kind of formulate, or once I formulate a business plan, let's say we want to do investing in non-performing loans, and then I find Spain is a good market, then I look for a CEO that will actually do the day-to-day business instead of me running the company on a daily basis. So in that way, we've started a company in Jordan called Money.jo. It's the biggest non-bank lender now in Jordan. It's been successful pretty much from day one. We started it in 2021. This year, about 45 million in revenue. Esketit. So Esketit is basically a platform where you can go online and invest into my lending companies. I'm not going to go into details of what it means invest into. You're not investing into equity. But basically, we borrow money from retail investors in Europe. We have over 20,000 investors, 50 million assets under management. And so that's a platform of how I fund my lending companies, because lending as a business is very capital intensive. New School, that's an embedded finance business that we started now in Saudi. We're looking for license. UAE, also looking for license. Mexico, we're launching now. So embedded finance is a cool term, but what it means, it's effectively, let's say you have an e-shop where you sell, I don't know, phones and gadgets and things like that. So when your customer is not able to pay you the whole sum for the purchase, they can pay you in installments. It's now popularly called buy now, pay later. So we provide the technology for these types of transactions to take place. AFU Capital, asset tokenization platform, that's what my business partner is focused on. So we want to combine crypto investors that have stable coins and Bitcoin to be able to directly invest from their wallets, as opposed to bank accounts, directly from their wallets into our lending companies, right? So we build a protocol to be able to do that. Spanda Capital, I'm running out of breath talking about my company. Spanda Capital, that's a loan portfolio investing business. So what we do is we buy overdue loan portfolios from banks. So let's say bank issues hundreds of millions of mortgage loans. Some of them go into default, right? And the bank doesn't want to have this defaulted portfolio on their balance sheet. They want to get rid of it to get some cash. And so we are the ones that go in there and buy these portfolios. So let's say, 100 million portfolio we could buy for 5 million euros, right? And then our job is to get more than the 5 million we paid for it, right? In addition, what we have been doing for a long time, but now it's more targeted, is instead of only building companies, we also buy businesses. Because when you have a little bit of capital and when you already are in the industry and you know kind of the ins and outs, you can start buying ready-made businesses. So we are buying lending companies that need debt to scale because we have this investment platform. So we buy a company, we plug it into our investment platform, and that way we can grow the business, right? So we don't have to build everything from scratch, you know, spend a year or two getting a license, getting the management, etc. We just buy the businesses outright. And a bit more broadly, we also look at fintech companies, so not only lending, but fintech companies generally. We look at deal sizes between 5 to 15 million. And the idea is, unlike, let's say, what VCs do, and we're going to talk about that quite a lot, or unlike what private equity or kind of standard investors, what they do is they buy a company with an intention to sell it off after a couple of years with a profit, yeah, by kind of optimizing, maximizing value, whatever, firing people and things like that. So what I want to do is I buy a company and I give it more capital so it can grow faster. If it needs some more competencies that I can provide, I do that. But then I want to make money through dividends. So I just want to increase the profit margin and pay out dividends. And that's how I get my investment back, right? So it's a buy to hold sort of idea. And we're actively looking for investment targets. So if you think of international lending fintech companies, then let me know. All right, so with this experience, I have a certain skill set, certain view on, you know, doing business, building companies, also investing. And it is fairly different from, as far as I've kind of observed, from people that operate in VC-funded tech or tech-enabled companies. I'll explain what I mean by that. So my angel investor profile is maybe not your typical angel investor profile that only looks at VC-backed, you know, startups that are mostly in tech. I do more other things. And also through my experience of trying to raise money from VCs and just seeing how this whole world works and just thinking with my brain rather than just reading TechCrunch, I've kind of come to some conclusions about VC-funded tech company investing in general. So one thing is I only raised money from a VC once. We tried it many times and had difficulties. I can explain why and how, etc. But back in 2014, we raised money from a VC. That was like a Series A for us, 2 million euros, and then plus a couple million in debt as well. Since then, we're trying to raise money from VCs as well, but we never managed to do it successfully. We traveled to Berlin, to London, you know, back in the Moscow, you could also go there, San Francisco, like everything. I've documented that on video and so on. The problem with trying to get money from VCs for us wasn't that we're not a tech company, because we're a tech-enabled business, right? Everything we do has a software behind it and so on. The problem was that I just didn't know how to position the story for the VCs well enough so that they get aroused and excited, right? And that's one of the things I learned. It's largely about the story. Of course, you have to have your business kind of fundamentals, but the story is super important. So that's why I would say my focus over the years has been on making a business in a way where we make profits, we pay dividends, right? Or sometimes we sell profitable businesses because they are generating cash flow, instead of focusing on how to package a story so that I could get money from a VC and so that I could sell my shares, right? Those are two fundamentally different, I think, ways of doing business. They're not exclusive. They're not kind of like fighting against each other. You can do both and everything, but for me, making money through dividends, through profitability has been the way to success as opposed to building VC-funded companies. So that's that. Also, I think an important point is that I'm not a product founder, right? I don't really give a shit about what my company does. Yes, of course, I'm more interested in finance and that kind of sort of area. If I would have to deal with a business that creates wooden toys for kids, I would be less excited. But generally, I love business because it's about creating teams, scaling into international markets, getting funding, structuring, the whole kind of chessboard, right? That's what I'm excited about. I'm not excited about like creating an app that will, solve some kind of a problem. It's just not how I think. And largely VC-funded companies or VCs tend to prefer founders and companies that are just, mostly product focused. So through this experience of having talked to many VCs, having tried to raise money from VCs across North America and also Europe, I kind of found that VC funding and also the game of startup investing, especially when those startups are eventually backed by VCs, is a bit like a cult, right? And this cult is described this was supposed to be like a joke, so I'm hoping there will be some laughs. So in a VC kind of world, it's all about paper valuations, right? So everyone's obsessed with what's the valuation, what's the multiple on revenue, and I sometimes kind of jokingly see when my kids are using Monopoly money running around, then it feels like the same with founders that do these valuations or are excited about valuations, because you don't get rich through a VC giving you money at a high valuation. You get rich when your money is in your account, right? And there's a big difference between that. So therefore you get rich only if there is an actual exit, which is what I find, to be difficult. I rather prefer to build a business that makes money and you can be rich, much faster than like maybe 10 years later. In the life of VC funded companies, you have to go to conferences, and in conferences you do two things. You chase super cool tech entrepreneurs, everybody admires them, and then you chase VCs. Those are the two things, which I did as well, quite a lot back in the day. Yeah, like I said, so the primary customer for a VC company, VC-backed funded company, is the VC itself, oftentimes, not the end customer. Of course, they try to juggle the two, but the obsession with the story and how do I get VC into the door often kind of, in my view, overshadows the purpose of the company. Also, VC-backed businesses, especially if you're an angel or looking to be a startup angel, you will notice that the companies that get successful and that they get funded, they fit a very narrow box, right? And it's literally, you could describe it with like a couple criteria. Number one is they have to grow 2 to 3 times a year. If you don't, then you're not getting funded. If you do, that's very good. High CLV to CAC ratio, so customer acquisition cost to customer lifetime value. So that's basically telling you how much you pay to get a new customer and how much you get money from that customer in revenue over the lifetime of the customer being with you in the company. So if the CLV is, let's say, 200 euros and the CAC is 20 euros, that's a ratio of 10, which is great, right? It costs you cheap to get paying customers. So that's another key criteria. Then, like I said, it's all about huge vision, changing the world, making it a better place, blah, blah, blah. And then lately, buzzwords. You always need to stick in all the bullshit buzzwords that are kind of more popular. AI, every fucking website is about AI and so on. So that's kind of how I see a company that is trying to be funded by VCs. They need to fit these like 3-4 criteria, which to me is a bit like Instagram beauty standard, right? You need to have duck lips, fake tits, on a beach in Bali, making pictures with a luxury handbag, right? And that's when you're considered beautiful. Yeah, no offense to anybody. It's just like
it works. It works.
It works. Yeah. Now that's all of this works for sure. That's the funny part. But the point is, it represents a small fraction of companies out there, and it represents a small fraction of how you as an investor can make money. Yes, and what it means to be an angel investor. It's not only investing in VC-funded tech companies. All right, my rant about VCs is done. Good. So how did I start investing? So I started investing when I was in my mid-20s, when I made my first capital that I could use and allocate and kind of start playing around with. So I had no strategy. So I made a bit of money, and then I thought, okay, I'm like this successful entrepreneur. I'm still young. So what all of these types of people like me do is they invest in startups, right? That was my kind of thinking, the depth of my thinking, right? Pretty shallow, but that's what it was. And so my motivation was, like I said, to be cool because, these tech founders, that's what they do. And I also invested, especially in the first deals, because I liked the founder. I wasn't critical about the product or the business plan or the market, none of that. I kind of wanted to be enthusiastically supportive of the person that was trying to do something, right? And even if they were trying to do something totally stupid, I was like, yeah, let's do it. Like, it's fine, it's cool, you're going to pivot. And that was kind of my mentality, which is what it was, just simply as that. And so, yeah, I thought I'm going to be a mentor. I'll help these founders and so on. I'll tell you how that kind of changed over the years. And so what I figured, obviously, is that when you do these startup investments, is one thing, it takes money to be able to do it, but the second thing is time, right? And the more you do these investments, the more questions if you do decide to get involved at least a little bit, you will have to deal with, help, connect to your network, there will be some work involved. And if it's one company, that's very little. If it's 5 companies, that's already more. If it's like 7 companies and you have therefore 7 or 14 people across those companies that you invested in asking you for some things here and there, that's a lot of like incoming, questions to deal with. So my actual track record. So I've invested over €1 million of my own money across about 16 deals. I don't remember exactly. It's roughly 16. It could be 13. It could be 19. So let's say it's 16. And as you see, I've invested across different areas like crypto, marketplaces, what else was there? Drones. Like, what do I know about drones? Gaming, and so on and so forth. So this doesn't include investing in real estate projects, investing in like real world assets. Let's put it that way. It purely means like kind of high risk angel startup-ish investing. So across those investments, 6 I've lost my money on, 5 deals, about 20% IRR. I'll talk about that specific part in a couple of slides, what I mean by this 20% and how I got it. And 5 investments are basically at the moment active. I don't know if I'm going to make money or not, or how it's going to turn out. And I said in the very beginning that I kind of don't actively invest in startups, and I promised to myself that I'm not going to do it. But out of those 5 investments, 3 I've done in this half a year, which is which tells me that my discipline is as good as my investment track record, But yeah, so some examples I can talk through. Obviously, they're not all of them there, but some that are I can give some comments on. And I'm not going to mention names, just the industry. So that was actually, I think, the first one, like a proper seed stage startup investment, was effectively like a platform that wanted to do a copy of Booking.com, but for luxury suites. Luxury suites is basically $500 per night or more, right? And so this is what I found about this company myself. Because I was looking for a website that specializes kind of on more expensive like hotels and suites. It was a good setup because the founders one was an entrepreneur from Latvia, and the other one was a hospitality expert from the US. They had met in an MBA course. Other seed investors were a bunch of other guys that they were studying with in an MBA. So that was like a social validation. So all the kind of like checkboxes were there. So I invested. I think it was a good idea. It was a good overall situation. But what happened is the co-founders, fell out. They started fighting over whatever problems. They were optimistic about funding. They didn't get it on time. They had a very short runway, and then they started fighting, and that was it, right? When the moment the founders start fighting in a startup phase, you're pretty much done. So that was one example. So I think I did not make a mistake myself there. It was all pretty good, but it was just, life happened. Agricultural drone. So this was a young guy that came to me. He was like 17, 18, wanted to build a flying car. Completely ridiculous. I thought, let's do it. Like, I'll help you. And also like pre-seed. That was just not even a pre-seed. It was like a meeting in a restaurant, like, brainstorming level. And I said, okay, I'm going to invest. It was a terrible industry. It wasn't even an industry. There's no industry for flying cars. It was just a very kind of very visionary. But it was an interesting experience. I worked with a guy for a couple of years in that I was helping him. We had regular calls. He was pivoting the idea to something more mature. And hardware is very difficult, hardware is hard, but flying hardware is probably the most impossible thing, right? So you have to have like so much money, and it just didn't work out. But the guy was very good. He's now working, I think, in a drone company, probably very successful, because now drones are the thing, right? Crypto trading fund. So I invested both in the actual crypto strategy, and I invested in the build out of the fund. It wasn't really a fund. It's not organized as a fund, but that's technicalities. Which was with a good guy, a good strategy. It was related with a business that requires funding, so that was kind of my strength. But the problem was I invested before one of the million market crashes, right before, like a fucking day before, like a month before it. And so it all crashed, and he lost most of the people's money that had invested. It was a couple of million. Like, what do you do with a crypto trading fund if you lost all the money? I mean, that's like, it's done. So that was another one. Modular housing manufacturer. So this was pretty funny. So modular housing. So, wooden modules that you stick together, and you have like small container size houses, or even bigger ones, but mostly, yeah. So this was a company that was kind of doing that with production facilities here. They had made a contract with a country in Africa somewhere, Rwanda, I think, and they needed money to increase production capabilities. And so we invested the money. There was a syndicate of 3 investors, 3 people, 3 of us put together €1 million. We invested the money, and shortly after, it turns out that this order they have from this Rwanda, client is delayed, but they had taken on the money, bought like production facility, machinery and things like that. Basically, it didn't go anywhere. They had very limited kind of sales coming in, and the founder was starting to act kind of weirdly. Maybe it was because she was under a lot of stress. At one point we thought that she's hiring actors to come to the board meetings, which is super funny, but never mind, it's a whole long story. It was a distressed kind of investment situation. We had to put in people on the board. We had to make sure they control all the outgoing, incoming payments, and so we had to take over the business. We were thinking about putting our own CEO and replace the founder because we thought the founder is not acting in the best interest of the company. Long story short, miraculously, the founder, credit due, she found an investor that bought us all out. We were very surprised, and we made a bit of actually money in terms of an interest IRR on that investment. And then a lending company in Asia. So this was where 2 young guys from the Baltics went to Indonesia, started a lending business, which we knew and understood very well. We put in money. The problem, it all seemed fine. It was a difficulty with the product market fit. They kind of copied the model that works in the Baltics, thought it's going to work in Indonesia, but it didn't. Regulation, there's a bunch of factors. But the biggest challenge I had was that these founders, they were not really listening to me or my business partner because we had a lot of experience. So we thought we were just going to put in some money and also tell them, some kind of suggestions and guidance in terms of how they need to scale this, which they didn't really follow. So that was a bit of a red flag. But I did manage to get the original money out from that investment. And I've invested again recently in their new business model, which is more mature, licensed. They've been in the market now for, almost 10 years. So it feels a lot more stable and more mature. So, that can also happen. Takeaways. So first and foremost, I would say I'm not a great startup investor. And what I've concluded is being an entrepreneur that builds businesses versus being an investor that specifically doesn't buy assets but invests in early stage companies requires very different skill sets, right? I'm a person that wants to get involved, active, let's do it, let's figure it out. I'm not a good person that sits on the sidelines, is very critically analytical at all times. I can be critically analytical when it comes to P&L and things like that, but not when it comes to cool new ideas or enthusiastic founders. I always kind of want to back them up and so on. So I think that's part of the reason why I'm not a great investor, and I don't think entrepreneurs necessarily means that you're successful in investing. And also I found it's a bit boring for me to be an investor. You just put in the money and you're just waiting. You're effectively waiting on the sidelines. While an entrepreneur, at the end of the day, you're the one that's actually kind of doing shit. So that's one takeaway for me. The other point is, like I said kind of in the beginning, is you need to define for yourself why you're actually doing this. Is it that why are you wanting to be an angel investor? Wanting to make money, that's obvious, that's for sure, even though I don't think that's an objective that you will reach if you just throw in money in a couple of startups. But objectives can be different. You can also expand your network. You can, through investing a little bit, you can learn a lot about a specific industry. You can get access to specific people and things like that. So there's a broad range of objectives. And what when I speak to founders in the Baltics, no matter how rich or successful or whatever, unless they're from Estonia, then one of their inherent motivations by investing into startups is they want to be like Estonians, right? It's like, this is the thing. They want to be like Estonians because obviously Estonians are very successful. They have this, unicorn per capita sort of miracle. So everybody wants to be like Estonians. So it feels like that's like a whole separate kind of category of motivations for angel investors. Anyway, of course, real learning starts when you lose money as opposed to when you put in money into a business and you're successful. It was interesting that my
first like a proper angel investor in our company, Dmitry, back in 2014, he put in like almost $500,000 equity, which is completely ridiculous. Like he made a biggest possible mistake putting in so much money as a first-time startup investor in a startup, right? Even though we were profitable and so on. But the point being, he made a lot of money by investing in our company, and it was kind of successful right from day one when he invested. And he made a conclusion that, oh, this is the shit. Like this is how I'm gonna make my next millions. I made millions in Russian real estate, and now I'm going to do startup investing. And I invest in Cream Finance, fucking awesome guys from Latvia, great. And then he piled in money into 20 other businesses, which all went nowhere. Maybe 2 companies went somewhere. But the point is, I think it's healthy that if you do these, angel investment things, that you get mixed results. You can get something that's successful, that gives you enthusiasm, confidence, etc., but also somewhere where you lose money, so you really think with your brain in terms of what you're doing. Because if you do make money, it's mostly because it's just lucky, right? If it's once or twice, it's not because you're very smart. At least that's the thinking I applied to myself. So my view on early stage startups is therefore it's low liquidity, you have to wait for a long time, you cannot get out easily, little control. Yeah, you can help, etc., but really the founder is running the business. Obviously, high-risk investments, and it's poor performance, right? If I would have tracked, like Justinas said, in an Excel file, like these detailed results, I could give you like a more specific, view on the IRRs that I was making. But I think oftentimes people just lose sight of the idea that these things need to make you money, right? It's not fucking about cool going to events and shit like that. It's about you having to make money. Because you work so hard, at least how I see it, is you work so hard to make the money. It's very irresponsible to put it into businesses kind of lightly, yeah, and then not make it back. So rather buy yourself like a super expensive car than put in money in a startup. That's how I think about it. Anyway, yeah, so, and of course, that's kind of a common sense thing. You cannot put in money as an angel investor in 3 startups and hope for some results, right? It's very likely that all 3 are going to go down. You have to invest in a number of businesses to get any results that you can actually speak about. And so with that, let's say you've defined your angel investor profile and you can pick the right strategy. I made a very complex model here with 3 strategies: serious, fun, and alternative. Serious strategy is where you dedicate a decent amount of money. I'd say like at least a couple of $100,000. 50,000 is not a serious amount of money. 100,000 is, it can be serious amount of money for a specific person, but objectively looking at investing in startups, if you have 100,000 to play with, you can do 5 to 10 companies, which is, it's not a lot. And what oftentimes, like what I did, I put in 50,000 in the first startup, right? At a very early stage, which was completely wrong. So anyway, so serious strategy is you have like serious amount of money that you're ready to dedicate. You think about the IRRs, the risk you're willing to take. You can compare, okay, in my main business I can make 20% year on year. In a startup investment world, I need to make 30, 40, 50% or more per year for my energy and effort to be worthwhile, right? We'll talk about how to select the criteria, etc. So sector, obviously, and so on. And importantly, in this case, you have to be able to dedicate a decent amount of time, right? Unless you have like a manager that manages your money, and that's a whole different story. That's a whole different level of wealth. But you have to spend 1 or 2 days per week, I would say, if you put in hundreds of thousands or millions into startups, because that's becoming part of your job. Next one, fund strategy. So this is what kind of I did. You start by doing, and then you start learning just by doing and understanding stuff without having to thought through everything, which is fine, and you see how it works. My problem was I started with a fund strategy with a serious amount of money, right? So that was wrong. That was the wrong kind of mix. An alternative strategy is what I ended up doing and focusing a lot more is you don't necessarily give equity to small startups, but you do different types of alternative like loans, you give equity and maybe you get collateral back, and in that way you cap your upside, and you're not talking like 10x, 20x, but maybe you get into positions where you can make 20%, 30% IRR, and you can get your money out in a year or two, right? So let's talk about these alternative ideas. Just to say also, this is not something I've kind of like got on Google. This is my own experience where I've made money with the alternative investments. I have almost, I think, never lost money. And so for me, this works, right? And it works in the context of being in Eastern Europe, right? If we're talking San Francisco or one of these massive capital markets, it's a different story, right? Companies get funded much easier, exits are faster. It's all of a different story. So the caveat to my presentation, importantly, is that we're looking at Eastern Europe, right? We're talking, doing deals in this region generally. So in terms of alternative investment ideas, IFs, alternative investment funds. So that's basically in Europe, it's a regulatory framework for Europe. If you want to invest in alternative assets, meaning not stocks or bonds that are traded on market, but something more interesting, energy, assets, collectibles, art, and things like that, and VC investing, high risk investing, it will be done through an IF, alternative investment fund. So an idea that I would consider is if, for example, you want to be an angel investor, but maybe you don't want to do it yourself, you can go to a VC fund and give the money to a fund, right? There's Lithuanian funds, there's Latvian funds, all of them are raising money from investors, and they will structure the fundraising by being an alternative investment fund. And in addition to VCs, there's a bunch of other types of funds that are IFs. They all, by default, most of the cases give 10, 15 to 20 to 25% returns. Of course, you're going to have to share upside, about 20% from the profits, 2% on average, 2% from the assets under management. And it's not easy to find good funds. But it's more likely, mathematically it's more probable, you're going to invest into a decent fund that gives you decent returns compared to finding a great startup that's going to give you a 10x return. Yeah. Second, crowdfunding platforms. So here I don't mean equity crowdfunding platforms. I don't mean Crowdcube or one of those, which I think is a pretty terrible way to invest. And we can talk about the reasons. So here I mean, again, alternative asset investment platforms, right? Have you put in money into crowdfunding platforms? Yes? Okay, some. So you already know this, right? They can give you 10, 15% returns, fairly liquid. It's not going to be, 10x or 5x ever. There are some risks also, fraudulent platforms, but generally it's a tool that works very well, right? Third, bridge loans. So this is maybe a bit more kind of funky, a bit more specific. So there are companies, especially kind of in the growth phase, in the scale-up phase, if we're talking about startup, VC-backed businesses, that in order to get to, let's say, your next bigger fundraising round, Series B or Series C, they lack, whatever. They need some more time to close a deal. Maybe they need some more proof of their business model. Because the VCs said, okay, like if you do this, come back after 7 months and we're going to give you the money. And they often need some funding, some bridge funding for that period of time. And that's where it's interesting. You can put in money 20% or higher per year. It's interesting that you can get it back very quickly. Those are not deals that last for more than normally a year. The problem with these is that as with investing in individual companies, you need to kind of like keep your eye open to these situations, and you need to have money available because these cases usually require quick decision making, right? They say, okay, like we want to get a bridge from a syndicate, like 100,000 or $500,000, and we need a decision by next week. But it's good returns. All right, a couple more slides. So in terms of building your profile, I think it's very common sense at the end of the day, right? First is know what's your objective. Let's say be like the Estonians. You can, with that objective, you can select a strategy, right? You can think about, okay, what is it that I want to do? Is it just purely making money? Is it, learnings about a new specific industry or some other scenarios? And then you can select your strategy. You can think about how much money, time you're ready to dedicate. Then you can select your investment criteria. The toughest from these points is, okay, you've figured out why you do it, select the criteria, you tell your business network that, okay, I'm looking to invest in companies, I have 10K per company. You tell everybody that you know that you're doing this, and sooner or later you're gonna have like leads coming in. The toughest part is to stick to your criteria, because you're gonna have random asks for money, random offers to invest, and they will be different from your criteria, and they will seem better than what you had in mind, these investment offers. So it's very important to stick to your criteria. So again, common sense, define what industry sector you're looking at. Clearly you would focus on the ones that are more familiar, where you have made money yourself, but that's not necessary. But that is something that seems like a logical to start with. Risks, so there are different stages, pre-seed, seed, Series A, growth companies, all the way to pre-IPOs. Pre-IPO investing into unicorns that are not public yet was a whole massive market on its own a couple of years ago when the IPO market was super hot. So that was also a pretty interesting niche to invest in, right? You could put in small amounts of tickets, big amounts of tickets into unicorns, bolts and things like that, and Revolut, etc. Therefore, a very reasonably low risk, but you would make money once that company gets on the public market, right? Only follow lead. Okay, so this is where you think whether you care whether other angel investors are investing, or you don't care, you're ready to go alone, or you decide that I will only follow somebody else, or even decide that I will only follow certain type of investors, professional investors only, right? So this is something to think about. Ticket size, yeah, whether you will, obviously, if you start, then smaller tickets is better, smarter. If you're more experienced, you can put in hundreds of thousands and so on. Geography, of course, you decide something that's familiar in the beginning, or where you have contacts, or where you can, let's say a business from Brazil comes to you and somehow you consider investing in it. If you have people that can help you with navigating Brazil in terms of legal, cross-checking references about the founder of that company that's asking you money, things like that. If you have contacts in that country, then you can select that as a geography as well. Level of involvement, I'll talk about that separately. So for me, this is not my criteria, just like approximate way to think how I would think about this is I would invest in consumer fintech, because that's what I know. Seed, Series A, I don't want to invest in idea level companies with very young founders. Something that's already validated. I only would follow other investors, so I don't want to be alone. I want to have validation from others. I can put in a range of tickets, 10,000 all the way to 100,000, for example. I would focus on emerging markets, so let's say Latin America, Africa, Southeast Asia. Why? Because my businesses are mostly in emerging markets, and so I feel comfortable with those countries, and I don't want to be involved. Yeah, for example, that's a criteria. I think this is an important part to answer. Like, how much do you want to deal with these startup investments? From my experience, I was, like I mentioned, very keen to help, because I felt like I was in the shoes of these founders that are starting companies. I was there myself just like a couple of years ago when I started these investments. So I thought I have like a few years of wisdom to share, and I was enthusiastic about it. And then the next thing I figured is these guys, some girls, but guys mostly, they would be asking me, okay, how do I open a bank account for my newly established US company? Or like, do you know a cheap lawyer that can help me establish an LLC in Delaware? Or like, I need to fucking get rid of my founder. Like, how do you do that? You know? And so they would come to you with these types of questions. I felt like it becomes like a babysitting experience rather than sort of investing. And so I was not that keen on getting very involved myself eventually. So my current approach is that I put in the money, but I don't say I'm going to help you with everything, come to me like at all times, etc., etc. I say if you have a specific problem, I might help you. Let me know. I'll maybe give you a call. So I guess one thing that I kind of developed for myself is not to give money or invest right when some investment opportunity comes to me. So rather what I do now is I spend time, I talk to the founder over like a period of, I don't know, a couple of months, depending on the situation. So I get to see if they're still with the idea, if it's developing in the right way, if they keep in touch with me, and then I might consider investing. So that's a way to kind of validate the person and the business. All right, so I think that's pretty much it. Last slide. So personal branding versus angel investing. There are people that ask questions in terms of how do we get very good investment leads? Do I need to be very public about my investing and so on and so forth? Long story short is, if your only objective is to have good companies to invest in and be a good active angel investor, of course you don't need a public profile. What you need is money and time. Yes, very importantly, money for sure, but also time. And I think this is how it worked for me, and I think it's the same with other actual investors that have money and are helping other companies, is if you're successful as an entrepreneur, you've done something, then probably you will be known in your little niche industry, or maybe in a wider industry, depending on how successful your business is. And you will have like a reasonable amount of people that you know. Some of those people will be experienced with investing in startups. So all you need to do is to define for yourself the criteria and let those people in your industry know that you're investing. And that's the first step. And some companies will start coming your way. You will start having kind of inquiries about investing. If, of course, you do choose to be public with your investment activities. I've done a lot of videos, but the intention was never about getting good investment leads. The intention was to share my experience and become famous. But no, to kind of share my experience and so on. And through doing that, I've seen two things when it comes to also investments. One thing is that, as Justinas mentioned, you have a lot of trash inbound queries coming your way through social media and so on and so forth to help, to consult, to invest money into completely unrelated industries from all over the world. So that's something you have to filter out. But the other thing is, with some more public profile, and especially if it's targeted, it will be just easier to invest into better companies, to talk to people or talk to founders that normally you would not know, so strangers. And unfortunately, people kind of make a mistake that if you're more well-known or recognized, that you're more competent or trustworthy, right? And you can abuse it or use it, but that's the one thing with some publicity, it's getting easier to talk to people, and especially in cases of like some hot company that is raising money or some cool investment opportunity or fairly closed investment opportunity, you have bigger chances of getting into those. Yes, that is that. I think we have enough time to talk about my YouTube channel. This is my real startup. I've put all my money, all my time into my YouTube channel, and I still haven't received anything back. So if anything, you could subscribe to my YouTube channel, and I will be grateful. And I think that's pretty much it. Guys, thank you.
Thanks, Matis.